10 was the intraday low during the day a week ago Thursday. That day, the S&P closed at 2728. So all these are in the mix right now based on where the futures are trading at this time. I don't think there's anything magic about that level, but typically the routine when you get a sharp sell-off is to look for a potential retest of those levels. And then when we get around those levels, ideally, if you were looking for an opportunity for a bounce or to get bullish, you'd want to see fewer stocks making new lows, maybe the VIX being lower. So sort of see lower intensity selling at those same levels. That might give some kind of a clue. By the way, I don't think you want to see the futures rally that much before the open. If you really want it to be textbook, you kind of want a morning flush as opposed to just kind of a fake rally heading into the open. All that stuff is out there. I also think another level that's interesting for the S&P, 2673, basically is the year-to-date break-even level. That's where we ended 2017. We crisscrossed that several times. Remember, we spent a lot of time down here and below this after that February sell-off. So I do think a lot of this stuff is, it's not exactly make or break time because you have had a lot of give and take around these levels. But it is interesting given the fact that at least cosmetically on the surface level, the earnings are good. But, you know, I came into the week saying, S&P's up 3% with S&P earnings up 20%. Clearly, the market is not purely being driven by that number. We anticipated a lot of that earnings, and then you've had a lot of the offsets as well from currency, from global markets, and from interest rates.
It's Michelle here. You know, look at 3M and Caterpillar. A lot of people describe 3M as a short cycle company, right? The stuff they sell, you're not doing a long-term contract to buy a large piece of equipment, and so in theory, it gives you a more immediate look at what's happening with the sales cycle in general and what might be coming. And then at the same time, you have Caterpillar, which is much longer cycle. What do you read into seeing both of these names getting hit so hard?
One thing you read into both of them is that the rest of the world has slowed down significantly, right? So you came into this year with a rare instance of most regions of the world growing nicely, and you've seen some of that fall away. But it's also some distinguishing characteristics, right? Caterpillar, the cost side, steel costs going up, that's something that's pretty specific to Caterpillar. 3M has kind of stumbled before in the past. It's an amazing company in how broad it is, and yet there's no one thing that sort of determines whether you have a great quarter or not. You know, bigger picture, the fact that industrials have been far below their highs, as well as housing and autos, the market is bracing for something. The market has been bracing for some kind of a slowdown, and it could be a head fake. It could just be one of these mini panics in advance of something that doesn't actually come to pass in terms of a slowdown. But clearly, the market's uneasy with the idea that we're going to be losing certain stimulus factors going into next year, while the Fed still seems kind of resolute about getting interest rates up. So that's where we're, I think, hashing things out right here in the market.
And 3M was having a tough year already, even before this,
that's right?
And what had been a strong market overall, they weren't a big participant.
Hey, Mike, that's an interesting point, though, just the idea that as this divergence that we've seen here in the United States versus other markets, is this the point where those other markets are sick and we catch a cold from them?
Yeah, I don't know if it's necessarily just that they are, it's a contagion effect from other markets. What it is all these markets are on some level reflecting a global reality. And the S&P 500 companies are a whole lot more global than the U.S. economy is. I think we always have to keep that in mind. And so if we have a little bit of a Wall Street versus Main Street tension in this country where the Fed's looking at great employment numbers and momentum on the domestic front, and they're going to kind of keep raising rates, well, the rest of the world where these companies are exposed to are not necessarily seeing things go great, and they're having margin pressures. That's why, you know, the markets here can suffer the same way global markets are. But I do think that divergence was big. You also had a big divergence with big tech companies here responsible for a lot of that U.S. outperformance finally faltering. So they've just come in a little bit. It looks like relatively normal corrections for a lot of the big NASDAQ names, but that remains to be seen. I don't think this market kind of finds its footing and really makes an upside attempt without those big growth stocks being a big part of it.